the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Hello and welcome to the Banking Show by Business Standard. In our main story today, we will look into LIC's exposure towards Adani Group and what it means for insurance policy holders. In our Banker's View today, we have with us Rajesh Kumar, MD of TransUnion Sibyl. Is it a good time to lock in fixed deposits? We will answer in our Banking for You segment. Our consulting editor, Tamal Bandhopadhyay, would join us to talk about the real interest rates. At the end of the show, we will share with you the results of our last week's poll and also tell you the poll question of this week. Stay tuned. India's largest insurer, Life Insurance Corporation, has been making headlines lately, and it is not for good reasons. Market experts have raised questions about the approach of LIC towards its investments in Adani Group companies. Could they have offloaded a portion of its investments in Adani to book profit and to later reinvest it? Has it unwittingly let down policyholders? Subrata Panda digs deeper.
The stocks of listed Adani Group companies have seen a downward spiral ever since US-based short seller Hindenburg released a scathing report alleging the group engaged in brazen stock manipulation and accounting fraud scheme. This report was released on the eve of Adani Enterprises' follow-on public offer, which was eventually cancelled even after full subscription. On January 30th, LIC said it had investments of 36,474.78 crore rupees in the Adani Group by way of equity and debt. The total purchase value of equity in all Adani Group companies acquired over many years was 30,127 crore rupees. Now, even after a month since the release of the Hindenburg report, Adani Group stocks continue to be under pressure. The share price slide has affected the investors of the company, including LIC. Reports suggest that the value of LIC's investment in Adani Group might have now declined to around 25,000 crore rupees. It cannot be ascertained whether the state-owned insurer has sold any of its Adani holdings or purchased more shares since the release of the Hindenburg report. Meanwhile, LIC has seen an erosion of 12.20% in its own share price since January 24th. The stock rose a tad last Friday to close a little higher than its 52-week low. Now, what does this mean for LIC's policy holders? According to experts, there should not be much of an impact as far as policy holders are concerned because LIC is one of the largest institutional investors in the country and it has investments in all marquee companies. So typically, even if it loses money in one of its investments, the loss gets offset by the profit it makes from its other investments.
LIC has a substantial investment in this group, and the initial figures indication which came that the value it was carrying was much more than the cost it has incurred. But as I can understand, in the last few days, maybe 10-15 days, there is further erosion in the valuation of the holding the LIC was having. So consequently, there may be some issue. But as I understand, LIC is a very big organization and the total investment in the group being less than 1%. So it is not going to affect seriously the LIC policyholder. But as a professionally, I can say yes, there can be some impact, but not a larger impact.
If there is some impact because of the slide in Adani Company's share price on LIC's investment portfolio, it's the participating policyholders who will get impacted in terms of reduced bonus.
What will be its impact? If you do some mathematics, you will find its impact on bonus for endowment policies for 20-year policy, which was 48 rupees last year, will be, in my opinion, to the extent of 4 to 5 paise. Means if at all the situation continues, or if at all today we have to declare bonus for with profit policyholders, then suppose as against 48, the bonus rate would have come to 49 rupees. Because of Adani's depreciating value, it may be 48.94 or 95. Means about 4 to 5 paisa less than what it would have been. So the impact is not that substantial.
Experts say that LIC's exposure in Adani Group companies is quite small when looked at from the perspective of assets under management. LIC had an AUM of over 46 trillion rupees as of December 2022. Even if LIC loses some money from its exposure to Adani Group companies, it is very likely to offset that loss from its investment in other companies like ITC and SBI, which have given healthy returns in the past year.
So the good news is, if LIC loses money in one of its investments, the loss would get offset by the profit it makes from its other investments. But there is a possibility of reduced bonus for policyholders. Moving on, credit bureaus are set to play a bigger role in the years ahead. In our Banker's View today, Rajesh Kumar, MD of TransUnion Sibil, tells Raghu Mohan that credit bureaus will help fuel consumer credit growth, which has a large bearing on the economy.
How do you view the credit bureau business at this point in time when retail banking has taken off in a big way?
Yeah, so Raghu, first of all, we being the fastest growing large economy right now, all of us know it's heavily fueled by our young population and we are a consumption-led economy. And to bring that to relevance to your question, in terms of how credit bureau business plays a role on retail banking, we're talking about a consumption-led economy, young population. Let's go to the next point on retail banking or retail lending. So Raghu, in a large country like ours, right, today, let's say a Raghu applies for a loan from a Kadalur to a Bank of Baroda. Both of them, of course, don't know each other, right? There are two things that come to play in that. So if the two entities that I spoke about, a Raghu the individual and Bank of Baroda as an example, or at a generic level, anybody, if I were to ask you for a loan, two things you need. First of all, you need to know my identity very clearly. Is Raghu the same Raghu that he claims to be? It starts with that. Then the second is what we call probability of default, which in common language we can say trust. Raghu has to know, first of all, that the person asking, or the bank has to know that Raghu who's asking for loan is the same Raghu that he claims to be, A, and B, we trust him to part with the money and it will come back with interest, what we call probability of default. Now you look at both this ID and PD, or identity and the trust factor, both of it, when people are sitting miles away in the marketplace, the trust is created by critical information on both counts. That information is what credit bureaus provide today. And if you look at our mission statement for Sibil, the purpose statement is information for good. And we define our business as we exist to create this trust in the marketplace. Now, how has this played out in terms of real numbers over the last 10 years? Because ultimately, this is the intent, this is the theory behind it. Let's look at the numbers to see if it plays out, okay? So over the last 10 years, Raghu, our retail portfolio at an industry level has grown 6x at a CAGR of 20%, okay? Then live consumers has grown at over the 10 years, it's grown 4.5x at a CAGR of 16. Number of women borrowers, right? It's grown 6x at a CAGR of 21%. Number of young borrowers between 18 and 30, 6x at 20% CAGR. Number of consumers with more than two products, 7x in the last 10 years. Then if I were to look at some other interesting statistics, right? First-time borrowers, what we call new to credit in the industry, right? There are 17 crore new to credit customers or borrowers in the last 5 years. And then we talk about deep geo. We are India. We talk about inclusive growth all the time. And when we talk about inclusive growth, all these segments that I'm talking about, be it deep geography, young borrowers, etc. Not everybody has fantastic 3 years IT returns and all a thick file based on which the lender sitting somewhere away can take a decision. So it's this information in the digital ecosystem which creates the right trust artifacts that actually creates this growth. So to sum up all of these points, I think if you talk about retail banking on one side and trade bureau business on the other, my summation would be that the two are entwined, intertwined, and highly synergistic. Both are critical to each other's growth. I link it back to where I started. Therefore, retail banking to grow, this is critical. And we know that retail banking has a direct correlation and a causative role to play in the growth of the economy. I hope that answers your question.
And what is your sense of the delinquency levels in the retail book?
Delinquency levels, Raghu, actually, if you see, even I've been a risk manager in a bank all my life. Now I'm sitting at CIBIL. I used to worry with the pandemic and all the lockdowns, right? Lockdowns, then we had moratoriums, rescheduling. One was always worried, kya hoga? But I think India as a country and the regulators, policymakers, overall fantastic job. So today, actually, Raghu, if you look at our retail portfolios, the delinquencies are well within acceptable ranges, well within normal thresholds. To give an example, auto loan delinquency, 90 DPD, I'm saying, which is the NPA ratios, is below 1%. Personal loan is at 1.01%. Credit cards is at 2.56%. These are like very, very nicely acceptable and affordable delinquency rates from a P&L perspective as well. In fact, some of these products in the last few quarters, Raghu, actually delinquencies have even reduced. And I think there are 2-3 factors again. There is good credit awareness amongst population today. People know that it's important to pay on time so that their credit history is intact. The second thing is, obviously, in a growing economy, loan books are also, in a robustly growing economy, even loan books are healthy. The only thing I would say at this stage on delinquency specifically, Raghu, since we work closely with banks, is that whenever we have good growth in the loan book size or in the advances, overall growth in the economy, just single word of caution is that bad loans are also made in good times, right? So to that extent, I think it will be important for, right now things are superb, very, very nicely stable, but it will be important for lenders to keep a close watch, look for early warning signals, monitor specifically for particular clusters which get overleveraged. We've seen all this in the past. When there's a growth in good markets, some 1 or 2 players will end up over leveraging particular segments of customers or particular geographies. So it will be important to keep a good close watch on young vintages, concentration and risk and leverage ratios. But otherwise, I think we are very well positioned right now.
And lastly, what is your initial view on the proposed National Financial Information Registry? How do you think this will impact the credit markets?
Yeah, I think, Raghu, first of all, little early to talk too much in detail about it, since we are all awaiting further details, except for the announcement by the finance minister a few days back. But overall, if you see in any market where inclusive growth is important, and then any market which is as digitally active as we are as a country with so many digital ecosystems, etc., a lot of different data sets are created by different sources, right? So to that extent, there is information asymmetry, etc., in a market. When we talk about the National Finance Information Registry, a lot will depend on the following few points to say what will be the construct of this registry, right? Who all will be the sources who provide this data at what frequency, right? And then what will be the ID systems, because each of these will have different ID systems, and we as a country do have multiple ID systems. So how will we converge those ID systems? And obviously very important will be who all get access to this data, because ultimately with such a registry, it's really about access so that we can all create value. And lastly, enabling regulation, because this data will come from very different sources. So the enabling regulation. So we will wait and watch this development closely. And last but not the least, at TransUnion CIBIL, we are very eagerly looking forward to working with the policymakers and the regulators to see, and the industry, to see how we can contribute, understand it better, we can contribute and contribute to our India's growth story.
Rajesh Kumar, it was wonderful talking to you, and we hope to engage with you soon in the near future. Thank you.
Look forward to that. Thank you.
Rajesh Kumar said that credit score will lead to better pricing on offerings and help increase the cross-sell ratio. That is, expand the share of the wallet that lenders have. What remains to be seen is how. For 2 years after the COVID-19 outbreak, those looking to keep their savings in bank deposits were at a disadvantage as banks sharply lowered deposit rates in line with cuts in policy rates by the RBI. That situation changed in 2022 as banks, under pressure to raise funds amid booming credit growth and tightening liquidity, rushed to raise deposit rates in order to garner funds. Bhaskar Datta in this next report explains why it is a good time for saving in bank deposits.
After the COVID-19 pandemic struck India, for more than 2 years, individuals looking to deploy their savings in bank deposits had to contend with meager returns. The reason? Interest rates were reduced to record lows to protect the economy. However, with persistently high inflation compelling the Reserve Bank of India to sharply raise interest rates since May 2022, the investment landscape has become a lot more attractive for savers. The RBI's rate hikes are being passed on faster to borrowers than savers, as several bank lending rates are linked to external benchmarks, which are reset almost immediately after the central bank's interest rate actions. Deposit rates, which represent liabilities for banks, are usually raised when a bank faces pressure to raise funds. That is the case at present, as bank credit growth has far outstripped growth in deposits for several months. As a result, banks have rushed to raise deposit rates to attract funds and to finance the booming credit growth. With surplus liquidity shrinking rapidly, banks have faced even more pressure to mobilize funds. At present, State Bank of India is offering a peak rate of 7.10% for general deposits under Rs 2 crore under a special scheme. The highest rate SBI is offering under normal schemes for general deposits under Rs 2 crore is 7%. Meanwhile, HDFC Bank is offering a peak rate of 7.10% for regular deposits under Rs 2 crore. For senior citizens, SBI's peak rate for regular deposits is 7.50%, while HDFC Bank's highest rate is 7.75%. This is a far cry from the situation in much of 2020 and 2021, when returns on bank deposits struggled to adequately compensate for inflation. In August 2020, the RBI had lowered the policy repo rate to a record low of 4%. The repo rate stayed at that level till May 2022. In 2020-21, the average retail inflation in India was 6.1%. The RBI's latest estimates project average retail inflation at 5.3% in the next financial year. The repo rate is currently at 6.5%, while the government's 364-day treasury bill is yielding 7.26%. So, the real rate adjusted for inflation is now in the positive territory. According to the latest RBI data, the weighted average rate on fresh deposits in May to December 2022 period went up by 213 basis points.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
So as Bhaskar said, that the real rate adjusted for inflation is now in the positive territory. Deposits are the flavor of the season, it seems. But are your returns on deposits beating the inflation? Our consulting editor, Tamal Bandhopadhyay, answers this and more as we discuss the real story behind real interest rates in our next segment. Hello, Mr. Bandyopadhyay, and thank you for joining us today. We're talking about the real interest rates today. And the first thing I want to ask you is that are the current deposit rates able to beat the inflation?
Yeah, Ruchika, yes. I think after quite some time now, we are seeing the deposit rates are higher than the inflation rate, which means the real rate for the depositors are positive. Now, typically for calculation of that, we need to look at inflation 1 year down the line, which by Reserve Bank of India estimate is 5.3. That's the inflation estimate for fiscal year 2024. And as we speak, you will find most of the banks, including the mainline large banks, are offering anything around 7.5% or even more. For senior citizens, even 8% or even more. So it's a plain arithmetic. 5.3 is inflation if you're earning 7.5. So your positive return is 2.2. Of course, you can talk about the tax, what we pay. Because depending on the tax bracket, whether it's 20%, 10%, 30% or no tax, you need to pay tax on the return. But when we discuss the real rate of return, we don't calculate the tax. So minus tax, purely from the point of view of inflation adjusted return, yes, what we are seeing at this point of time for the fixed deposits, the depositors are in the money, positive.
What is it that the real interest rate should be based upon?
Well, I think what you are hinting at, what should be the benchmark? I think that's the question. Yeah, what should be the benchmark it should be linked to? Well, there are various theories. Former Reserve Bank of India Governor Raghuram Rajan spoke about 364-day Treasury bill. Now, I think there are various point of views. Should it be the Reserve Bank of India in Indian context, the policy rate, or 364-day Treasury bill, or something else? There is no real answer as such, but I personally feel that when we are calculating the real rate of interest, I think we need to consider all the benchmarks available, right from repo rate to 364-day Treasury bill rate, everything. Like for instance, repo rate is this point of time 6.5, and if you're earning 7.5 or 7.75 interest rate on your term deposit, then again you are positive. Again, there's a tax part of it, but that we don't consider when we consider the real rate of interest. So real rate of interest at this point of time, by any benchmark, whether it's 364-day Treasury bill or the Reserve Bank of India policy rate, are positive. And as I globally, the central bankers have been talking about the real rate. Our central bank governor Shaktikanta Das also, after the presentation of the last policy early February, he also spoke about that we are seeing the rates in the positive territory. So that's the objective of all the global bankers, US Federal Reserve, you call it, I mean, any global banker. And we are there.
Where do you see the deposit rates going from here?
Have we seen the end of the rate war? Probably not. I would like to believe there is still possibility of rates going up. Because there's a fierce battle on the deposit rate of something which is unprecedented. The bankers who have 30, 40 years of experience, they have been in the industry. They are saying that they have not seen this kind of pressure on deposits. So typically what happened, the banking system in India, liability, you take it for granted. You will keep on getting calls for home loans and auto loans and personal loans. But for deposits, rarely, because depositors are taken for granted. For the first time, you are seeing that the bankers are wooing the depositors with higher rates. Of late, there's a new instrument coming up. It's a non-callable deposits, which means you are locking yourself for 2 years or 3 years. You're not allowed to take the deposit back under any circumstances. Normally, when you are having 1 year or 2 year deposits, for emergency, you can break the deposits. You need to pay some penalty, but you can take away your money. But now bankers are using that non-callable deposits also and paying you some 25 bips more. Have we seen the end of the rate war? I would like to believe no. It could go up even further. And a related thing, you have not asked me, but I am telling you, have we seen the end of rate hike? Probably no, it's still wide open. There could be, all depends on the inflation numbers and what happens in US. What does US Federal Reserve do at the next FOMC meeting? We need to wait and watch. Yeah, as we speak, it's very difficult to say. But I would like to believe, looking at the inflation trend in India, it's a sort of 50-50. There could be yet another rate hike in April. And yes, as a corollary to that, the commercial banks have no choice but to hike their deposit rates. So if you have your money, I mean, be cautious. It's not a forum for personal finance, but don't put all your money in one basket right now. Stay liquid. You get probably a better opportunity a month down the line.
So, Mr. Bandyopadhyay, you hinted that deposit rates could go up, but as far as the overall rate hike goes, it's 50-50. Good piece of advice coming our way, that don't put all your eggs in one basket. Thank you so much for joining us today and sharing your insights. A very valid point that comes through is that while the debate will continue about what should be the benchmark rate to calculate real interest rate, both for the lenders and the savers, shouldn't all rates be higher than the rate of inflation? It is time now for our poll results. We asked you last week, do fixed deposits make sense again for savings? Most of our respondents, well, 59% felt yes, it does make sense, while 41% said no. The EPFO members as of September 1st, 2014 would now be allowed to choose a higher pension based on their actual basic wages. You can make higher contributions towards EPS at 8.33% instead of the maximum ceiling of 15,000 rupees pensionable salary per month. Some experts say that the decision is really whether you want a higher monthly pension or a huge lump sum upon retirement. So we are asking you this week, should you go for a higher pension under the new EPFO scheme? Our polls open on Friday, and you can respond on Twitter, Instagram, LinkedIn, Telegram, and our website. We will be back next week with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
I am the blue of the limitless sky. I am the inspiration that lets success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.